Hi, I'm Richard Rosso, Director of Financial Planning and contributing editor for Real Investment Advice, here with John Coumarianos, market analyst extreme, as well as advisor. And when the Brooklyn boys are in, Lance is afraid.
That's right.
To walk in here. And speaking of fear, volatility is back, right, John?
Fear and volatility are both back.
So John's got an article coming out tomorrow, but we wanted to give you a good overview and how to think about this in a way that's clear-headed. And I want to go through, just give us an update on what's happened so far. I mean, as far as...
Just a few interesting statistics. I mean, we were up about 11% on the S&P 500 at the peak, which was at the beginning of the month, and we're flat. Now, we closed yesterday up about 1%, so we lost about 10 percentage points. So that's a correction.
Gains for the year are gone.
Gains for the year are gone. That's painful, but we're flat for the year, so it's a year of no gains right now, and we're up today as we speak, I suppose. So that's the interesting statistic. It feels bad to lose it all in 1 month. It is a little bit unusual to have that kind of decline in the space of a month, but at the same time, it's only a correction so far.
So let me ask you, what's more unusual? What just happened, or what happened last year as far as zero volatility?
Well, that's the other thing. It feels bad because it was in a month and it's a compressed period of time, but we've also been conditioned by the markets to be a little bit complacent. We've said this before, Rich, but last year was the first year in recorded history that the S&P 500 recorded gains in every single month, not one down month. And in fact, it extended into this year too, because January was a gangbuster month where the market was up a lot.
Yeah, and that's interesting. So think about this. So I always say this, no matter what your allocation, so say you have a classic allocation, you have 60% of your money in stocks, you have 40% in bonds, right? People have hated that this year, right? It's like, my money is not going anywhere. What's going on? But I think after these last few days, you might be glad you had bonds in the portfolio. So give us a perspective on what we call the volatility, because you will see volatility. I think volatility is back. The market's normalizing, thanks to partially the Fed, maybe partially tariffs. But tell me a little bit about what a 60-40 blend would feel like, as far as movement and so forth.
Over the course of history, the classic balanced portfolio, 60% of your assets in stocks, 40% in bonds, that portfolio has delivered about a 10% what we call standard deviation or volatility characteristic.
So my swinging of my portfolio, 10% for a 60-40?
10%,
wow.
10%. So
and you would think it would be less.
You would, but it swings a lot. You still have 60% stock exposure.
That's right.
And that's going to make the portfolio swing a little bit. And that's, in a way, what you have to suffer to incur the gains of the stock market.
That's the ride you're supposed to be on.
That's the ride, that's the price, as we like to say, that's the price you have to pay for entry into the financial markets. And bear in mind, standard deviation captures most of the moves, but not all of them. So sometimes you even get some bigger moves. So a balanced portfolio will move around a lot. Let me note also, for the last 3 years, the standard deviation of the Morningstar moderate allocation fund category has been 6%. So you've had 1/3 of that volatility lopped off, and so we've really been, again, conditioned for too calm markets that are really too calm.
So what would bonds do for me here? Even though I do have volatility because I do have stocks in the portfolio.
Yep.
Well, bonds have been hated.
Bonds have been hated, and you know what? They're down a little bit for the year, but boy, did they hold up this month.
They sure did.
They provided terrific ballast to any portfolio. If they were investment-grade bonds, as long as they weren't junk bonds, they provided very good ballast to a portfolio this month, and I can guarantee you, if you held them this month, you're very glad you've held them.
Or maybe you're not. You should be, though.
You should be.
Only because if you look at what the markets have done quarter to date, let's look at the MSCI World Index. What is that down? About 10?
So
with international stocks for the year?
So with international stocks are actually down fairly substantially for the year. So through yesterday, I think the MSCI All Country World Index, the whole world stock market, was down 4%. And that includes the U.S. market, which was flat or up 1% through yesterday. So you can imagine the foreign stocks in that are down even more.
I think where you see the devastation and the scariness of the ride is the quarter-to-date numbers.
Yeah.
And you can see, if you had bonds in the portfolio, you really appreciate them.
Yes.
Because when you look at the S&P down close to 9%, and some areas in the market down more than double digits, double digits, about 10, 12, 15%. And then you look at an allocation that has had bonds in it. you might be down 2%,
Yeah.
3%.
Yeah.
I mean, listen, I'm not saying that's great. What I'm saying is you are down much less than
Look,
the overall market.
bonds are down slightly for the month, but less than 1%. The big index, the Bloomberg Barclays Ag, is down less than 1% for the month, or through yesterday. And so that's a real boon to any portfolio.
Mm-hmm. So the key to this message, before we move on to just an additional message, is volatility is here to stay. We watch that.
Yeah.
That does not mean that you go ahead and sell immediately.
Right.
You need to have rules and a discipline to make those sales. So even though we have a sell discipline, and it's very clear what we do, we've got to give portfolios the ability to ebb and flow. That's just par for the course. Am I right, John?
Absolutely. No one's
Yeah.
going to, sell the whole portfolio out at the very top of the stock market and then buy everything back in at the bottom. That's just not possible.
I wish I could do that.
Yeah, that would be amazing if we could.
I wouldn't be here with you right now.
I can tell you that. Brooklyn would be somewhere. We'd be somewhere else.
Brooklyn would be on a beach. Well, a couple of things. John and I are going to go over this a little bit. John, if you step out, but
Sure.
I want you to give us your opinion.
Yeah.
So give me a V for volatility, right? Volatility can cause you to lose focus. We've seen it.
Yes.
Right? People get nervous. I don't feel right. I don't feel like there's any upside left. You just hear a lot of this. And I think it's because, again, we went through a year last year that was smooth as glass on the way up.
Yeah.
I mean, I would come in and shake my head at, it was almost like investing in a sure thing.
The
and
market
that
couldn't go down.
No, market could not go down.
And of course, behavioral economics tells us we have recency bias. And what does that mean? We take what's happened very recently and extrapolate it into the future. So it's been calm recently. We think it'll be calm in the future. And then we're shocked when the volatility comes, but we shouldn't be.
So every portfolio moves like a pendulum. What you need to decide as an investor is how big of a pendulum and a swing do you want? See, we want you to get to focus on the right ball. The wrong ball is the focus of the returns of the market. Market moves are important. Listen, we tell people all the time. I had an email with a client the other day, and he goes, I'm worried. I need you to stop me from worrying. So you're going to laugh. What I said to him is, no, I want you to worry. Because I don't like advisors that tell clients, don't worry, we'll take care of it. No, a little worry is good.
Yeah.
That means you're aware.
Yeah.
It's the actions you take.
Yeah.
And if you can step back and refocus, that's very, very important. So the market moves should not be your focus. The focus should be the return required to meet what I call your financial benchmarks, your personal financial benchmarks, and that comes from actually doing a financial plan, which we are advocates for. We talk to every client. We say, listen, we do plans. We want you to make sure that you know your goals and you need the returns, or what kind of returns do you need to hit the goal.
By the way, having a little fear will get you into the right allocation so that you don't sell and you don't panic when stocks go down. That's the important thing about taking some of your fear seriously. It won't get you overextended into stocks or overexposed to stocks.
Because what would we find is when stocks are going up, more people want to be invested in stocks.
Right.
And that's perfectly normal human behavior. It may not be right, but it is certainly something we see.
Yeah.
Okay. So what is your personal financial life benchmark? In other words, do you know? Do you know what kind of return you need to hit the goals that you set, the milestones, whether it's college planning, retirement planning? Most people don't. We want to make sure you as a client, you know what it is. What's your hurdle rate? And again, that's the rate of return you need to exceed or at least meet every year to make sure you hit those goals that you establish. So think about this. If you've run a financial plan and you need a 3% rate of return to hit your goals, an increase to 4% is a 33% increase in return. Hey, I'll take it. I would want 4% over 3%.
Sure.
But we never look at the other side, or we rarely look at the other side of the coin. It requires roughly a 100% increase in risk. I don't think I'm ready to take those odds just yet.
You have to incur a lot more risk and volatility
To get
achieve
a
that
level return.
extra return. Yep.
We never focus on that.
We don't.
Because just we're human, right? We want return, but we don't realize how much risk you're taking to get it. So we ran a chart here for you. So you did what you were supposed to do. You did what you wanted to do as far as you ran a plan. And that plan said that at 3% rate of return, you're going to hit your goals. Excellent. What we want to show you in this chart, this red line, if you could see that, is your 3% rate of return. Now, and this is based on the growth of $100,000 as an example, okay? Now there's a gold line. And the gold line is the growth of $100,000 at 20 times earnings.
So invested in the stock market when it's a little bit expensive, on the expensive side.
Right. Now, am I going to probably call my advisor around here and say, wait a minute, I'm not getting this return, I'm getting my 3%. Well, that's pretty much...
And by the way, I'm getting a lot more volatility.
I'm getting a lot more volatility, right?
You got some ups and downs here.
Although I might get a smoother rate of return. Now, the blue line, that's 10 times earnings.
So stocks are much cheaper.
And stocks are much cheaper. But what I'm trying to help you understand here is your focus is the red line. Your focus isn't the blue line, and your focus isn't the gold line. Now, if, say, let's go for an example here. We have this example where we're putting in, we have 100,000 and stocks are at 10 times PE. And I only need 3% because I've done such a good job of saving. I've done such a good job of managing debt.
The more you save, the less of a return you need to make on the savings to meet your goals.
So there's a couple of things that you might want to do here. You will still get, even in a conservative allocation, right? If stocks are cheap and your returns of that stock market is going well and that segment of your portfolio is doing well, well, guess what's going to happen? You're going to have a great problem if your goal is 3%. I'm going to have more money.
Yep.
I might have to add another goal.
Yep.
I might have to travel to another place a little bit farther than I wanted to. I'm not just going to go to Fredericksburg. I'm going to go to Italy. Right, John? We're going to go to Italy.
We've got it.
Yeah. So what I'm trying to say here is the volatility is also something you need to keep in mind. And you also need to be sensitive to what happens, even though stocks are doing better than your 3%. And look here, John. There's a point where that red line and that gold line intersect, right?
Yep.
Where I'm maybe taking more risk in stocks, but guess what? I'm not getting any more return.
You're not generating more return. That's right.
Right.
And it actually lasts for a few years.
Can you say that again?
Yeah.
There's just that whole about getting more return.
Okay, sure.
This stupid system flashed a blank.
Oh,
In the middle of what you were saying.
is that because of the web? Is the internet slow or something?
No, it's a hard wire.
Oh, it's a hard wire.
So
All right.
just whatever you said, say it again.
Okay. So the growth of $100,000 when PEs are 20 times earnings, that gold line is really fairly muted. It's almost giving you the 3% maybe of a blended, what a blended portfolio would be doing, right? So am I really, when you think about, look at the delta or the difference in the gold and the red on the lines. Why am I willing to take more risk to just do a little bit better?
Right. If we risk adjusted or volatility adjusted that return, it wouldn't look so good. The red line might actually look better on that basis.
But you know what? If we had a client that came to us and said, listen, Rich, I know my goals. My personal financial benchmark is 3%. But stocks seem cheap. There seems to be an opportunity. Hey, if valuations warrant it, why not?
Right.
The good part is we might have to revise your plan. And that's an important thing to keep in mind about a financial plan that you do. It's a living, breathing document. It's going to change. You're going to have some good things that happen. Unfortunately, you might have some financial setbacks as well. But most important is if you need to work a plan to generate this red line. Now, we use 3%. Your hurdle rate, John, might be less than 3.
Right.
Mine might be higher than 3. And you know what? The other day, I had a person come in and looked at a plan, and his hurdle rate was 7%.
Yeah.
What do you think I had to tell him?
That it was going to be difficult for him to meet that hurdle rate.
Unless he does what?
Unless-
he saves more,
right.
cuts back debt. In other words, he's looking to the market to make up that
To-
difference.
right.
And that is not, I don't even care if valuations are at 10 times earnings.
Yeah.
That's not the right way to do
It's
it.
not the right way to do financial planning. You need to save a lot so that you have a margin of safety so that you don't need massive market returns to bail you out.
Yeah,
Otherwise, you're like one of these public employee pension funds.
exactly. So how is the hurdle rate created? The hurdle rate's created is when we planned, when we look at the allocation that you should have in your portfolio, we administer a test, right? It's a behavioral test. It gives us an idea of how much risk you're willing to take. From that, we're able to help you create what we call the hurdle rate, or what the number you should be focusing on. Unfortunately, the hurdle rates are getting a bit lower, and the reason for that is why? Valuations, so here's a PE of 25, well here's 30. This is the 10-year forward returns from certain PE levels.
So all these dots represent a forward 10-year return from a particular PE level. And you can see there's a decidedly lower to the right slope. And what that's telling you is as you pay more for the stock market's earnings, you get lower returns. As you move to the right, you also move down. As you move to the left, as you buy the stock market cheaper, you tend to get higher future 10-year returns.
Yes. So let me be clear. When you create your hurdle rate using your your financial plan that creates this, you might need a hurdle rate of 7%. Our job is to tell you whether that's realistic or not. Based on this chart, it's not. And if you are one of the lucky ones who's done such a great job, or more disciplined ones who's done a great job saving and managing debt, or maybe your expectations in retirement are not so lavish. You're going to have a great retirement, but it's not as elaborate as it might be. Your
Not
spending behavior is going to be a little bit more muted.
Yeah, not as many expensive trips, that sort of thing.
Right. So, but you're still going to have a great retirement. Well, that's good because your hurdle rate will be lower. But either way, we have to, as planners, help you understand that hurdle rate. So what's the lesson here after all this? I guess we could have done this in like a minute.
This could have been a minute, exactly.
But you know, Brooklyn people, they like to talk.
We've got to drag it out.
Volatility is back. What you saw last year was not the norm. So you've got to focus more on the risk you take to get the return versus the return.
Last year was not realistic with the stock market going up every single month like clockwork. This is reality. You're in reality now with this kind of volatility, and you should expect this probably in the future.
I'm Richard Rosso.
And I'm John Coumarianos.
Now tomorrow, keep an eye out for John's article that's going to sum up a lot of what we talked about here, called Volatility is the Price of Admission in Markets. And if you need to contact us, we'd love to hear from you. You can go to realinvestmentadvice.com, ask us a question. Of course, as clients, you have our numbers. Please give us a call. Thanks again for listening.